Up to this point in the chapter, you have learned what value is, how it is created, and how appraisers estimate it with the sales comparison, cost, and income capitalization approaches. In this section, you bring two important pieces together. First, you look more closely at how income and expenses actually drive an investor's target price under the income approach. Second, you step back and see how appraisal practice itself is regulated and standardized so that these valuations are credible, consistent, and trustworthy in real estate transactions across the country. When you advise buyers and sellers, especially investors, you are operating in a world shaped by both numbers and rules. The numbers come from rents, vacancies, operating expenses, and desired returns. The rules come from federal law, state licensing requirements, and professional standards, such as the Uniform Standards of Professional Appraisal Practice. Understanding both sides will make you a more confident and credible real estate professional. Income and expenses in the income approach. Consider Tom, a real estate investor who is not buying a home to live in, but a house to rent as a business investment. Tom is not asking, "Do I like the kitchen?" or "Is this a good school district?" in the same way an owner-occupant might. Instead, he is asking, how much money can this property realistically make after all expenses? And what price makes that income an acceptable return on my investment? This way of thinking is the income approach from the investor's point of view. The income approach, as an appraisal method, converts a property's net operating income into a value indication using a capitalization rate. Tom is informally doing the same thing. He is looking at income, subtracting expenses, and then comparing profit to price using his personal rule of thumb. For Tom, the more profit a building makes, the more he is willing to pay. That means increasing income and controlling expenses are both critical. Income starts with monthly rent, but it can also include pet fees, late fees, charges for extra parking or storage, laundry income, or even utility reimbursements if the landlord pays the bill and bills tenants back. In an apartment building, vending machines or coin-operated laundry can be meaningful additional sources of income. On the expense side, Tom knows that no property is free to operate. Even if he pays cash and has no mortgage, he will still owe property taxes, hazard insurance, and any utilities or services he chooses to cover. These regular, recurring items are ordinary expenses. Some of them are fixed, meaning they do not change much from month to month, such as a fixed insurance premium or a fixed-rate loan payment. Others are variable, such as utilities, repairs, or services that rise and fall with usage and market conditions. Tom also understands that vacancy is an expense in everything but name. No matter how good the property or management, there will be periods when the property is empty or between tenants. It may take time to clean, repair, and advertise, or seasonal factors may delay re-renting. Conservative investors build vacancy and non-payment into their budgets as a percentage of income, such as 10%. So they are not surprised when a unit sits empty. Finally, there are capital expenses. These are not the everyday minor repairs, but the larger, less frequent items needed to keep the property marketable over time. Roofs, heating and cooling systems, water heaters, and major interior replacements like carpet or flooring. To prepare for these, Tom sets up a replacement allowance, essentially a monthly savings amount, earmarked for big-ticket items he knows are coming. Now see how all this affects his target price. The property Tom is studying is listed at $100,000 and could realistically rent for $1,200 a month. Tom uses a personal rule. The monthly profit after expenses should be at least 1% of the purchase price. 1% of $100,000 is $1,000. So Tom wants at least $1,000 per month in profit. He knows he has no mortgage payment because he is paying cash, but he still must cover $25 per month for insurance and $50 per month in property taxes. He also assumes 10% vacancy, which is $120 per month at the $1,200 rent. When he subtracts those items from the gross rent, he is left with $1,005. Next, Tom looks at capital needs. The roof will likely need replacement within about 3 years at a cost of $6,000. He wants that money set aside within 2 years. So he divides $6,000 by 24 months and budgets $250 per month into a roof replacement reserve. He then decides to save another $100 per month for long-term capital items like carpet and major interior updates. His capital reserves total $350 per month. When he subtracts $350 from the earlier $1,005, Tom is left with a projected monthly profit of $655. Under his rule of thumb, the monthly profit should equal 1% of his purchase price. That means $655 should be 1% of what he pays. 1% of $65,500 is $655. Based on his income and expense assumptions, Tom concludes that he should not pay more than about $65,500 for the property if he wants to meet his personal profit target. This is the income approach in action at the investor level. Tom starts with rent and other income, subtracts realistic operating and capital expenses, and then backs into a price that delivers his desired return, estimating market value with the formal income approach. Now imagine you have a larger budget and are looking at an apartment building instead of a single house. You have $500,000 available and 2 candidate properties in mind. One is not yet listed, but may be available at a price within your budget. The other is listed at $650,000, but you believe the seller might reduce the price. To decide which property to pursue and at what price, you want to estimate their market value using a more formal version of the income approach. Market value, in this context, is not necessarily the contract price or the sum of land and construction costs. It is an informed opinion of the most probable price a willing, unrelated buyer and a willing, unrelated seller would agree upon in a fair sale, with no unusual pressure on either party and adequate exposure to the market. For income properties, real estate professionals often prefer the income approach because the true value of an apartment building, shopping center, or office complex is in the income it can produce. The formal income approach uses a clear formula: annual net operating income divided by an appropriate capitalization rate equals value. To apply this formula, you move through a series of steps that mirror what investors like Tom do, but with more structure. First, you estimate the annual potential gross income by adding together the monthly rent for each unit, then multiplying by 12, and adding any other consistent income, such as laundry, vending, or parking. For example, if the building has 3 units renting at $1,200, 4 units renting at $1,500, and 2 units renting at $2,000, you first add the monthly rents and then multiply by 12. The result is $163,200 in annual potential gross income. Second, you calculate effective gross income by subtracting expected rental loss for vacancies and unpaid rent. If you know a particular lease will end and the unit may be vacant for 3 months, you subtract those 3 months of rent from the potential gross income. In the example, subtracting 3 months of one lease at $1,200 reduces potential gross income to $159,600. Third, you calculate net operating income. You add up all annual operating expenses, including real estate taxes, utilities paid by the owner, insurance, routine maintenance, repairs, management, and administrative costs, along with a reserve for capital expenditures. You then subtract this total from effective gross income. If operating expenses total $126,000 and you reserve $8,000 annually for capital expenditures, you subtract $134,000 from the $159,600 of effective gross income. The remainder, $25,600, is the annual net operating income. Fourth, you estimate the capitalization rate. You can do this by asking experienced investors and brokers what rates they are using, or by analyzing the income and sale price of comparable properties. Suppose a friend owns a comparable 10-unit building. You estimate its annual gross income at $222,000, allow for 6% vacancy, subtract $126,000 of operating expenses and $9,900 in capital reserves, and arrive at a net operating income of $72,900. If public records show that the building recently sold for $1,200,000, dividing $72,900 by $1,200,000 gives a capitalization rate of 6%. Finally, you divide the net operating income of your subject property by the capitalization rate. In the example, dividing $25,600 of net operating income by a 6% capitalization rate produces an indicated value of about $426,666.67. If your budget is $500,000, this estimated market value suggests that the property may be within reach, depending on negotiation and your investment goals. This formal version of the income approach matches the underlying logic you saw with Tom's single-family rental, but uses standardized steps and vocabulary, making it suitable for professional appraisals and lender underwriting. Regulation of appraisal practice, FIR, REA, and licensure. Accurate valuation is not just a technical issue, it is also a regulatory and public confidence issue. The savings and loan crisis of the 1980s exposed the danger of inflated and poorly supported appraisals in federally related transactions. In response, Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act in 1989. Title 11 of this act created a framework to regulate appraisal practice more tightly. Under Title 11, all appraisals used in federally related transactions must be performed by competent individuals whose professional conduct is properly supervised. As of January 1st, 1993, appraisals for these transactions must be completed by state-certified appraisers. A state-certified appraiser is someone who has met education and experience requirements, passed examinations, and demonstrated competency according to criteria that conform to federal standards and the uniform standards of professional appraisal practice. States base their licensing and certification criteria on minimum standards established by the Appraiser Qualifications Board of the Appraisal Foundation. States can, and often do, impose additional requirements, but they cannot be less strict than the federal minimums. For licensees and brokers, this means that any time a transaction involves a federally regulated lender and requires an appraisal, that appraisal must be completed by an appropriately licensed or certified appraiser. Uniform standards of professional appraisal practice and professional conduct. The Uniform Standards of Professional Appraisal Practice, commonly known as USPAP, is the backbone of professional appraisal practice in the United States. Developed initially through the cooperation of several national appraisal organizations and now maintained by the Appraisal Foundation, USPAP sets out ethical requirements, performance standards, and reporting expectations for appraisers. One key element is the competence provision. Before accepting an assignment, an appraiser must assess whether they have the necessary knowledge and experience to complete it credibly. If they do not, they must either acquire the needed competency, associate with someone who has it, or decline the assignment. If they proceed while acquiring competency, they must disclose this to the client, so the client understands the limitation. Another element is the departure concept, now addressed through the idea of scope of work. Appraisers may perform more limited assignments as long as the scope is clearly defined. The limitations are disclosed, and the resulting report is not misleading. A lender may not always need a full narrative appraisal report. In some cases, a restricted report is sufficient. In every case, the appraiser must ensure that the scope of work is appropriate for the intended use of the appraisal. USPAP also sets expectations for due diligence and market analysis. Appraisers are expected to analyze current conditions, such as multiple offers on listings, days on market, inventory levels, the behavior of distressed sales compared to typical arm's length sales, and sub-market trends in particular neighborhoods, price ranges, or property types. They may need to recognize that some markets are improving faster than others, that some offers above list price are supported by market competition rather than concessions, and that building permits for new construction can signal strengthening demand. When values are changing, appraisers must carefully support any adjustments they make for increasing or decreasing markets. Every written appraisal report, whether a full appraisal report or a more limited restricted report, must clearly state any extraordinary assumptions the appraiser has made and must explain that using those assumptions may affect the assignment results. For example, if there is a visible crack in a foundation wall that the appraiser cannot fully investigate, they might state that the appraisal is based on the extraordinary assumption that the home is structurally sound and that the crack is cosmetic rather than structural. This alerts the client that if the assumption proves false, the value conclusion may not be reliable. Appraisal standards also recognize specialized assignments. An appraisal review is not a new appraisal of the property, but an opinion about the quality of another appraiser's work. Mass appraisals involve valuing large groups of properties at once, such as for property tax assessment, using standardized data and statistical models. Appraisers may perform real estate analysis in the form of comparative market analyses or broker price opinions, although those are usually done by brokers rather than licensed appraisers and are not appraisals under USPAP. Other appraisers specialize in personal property, machinery and equipment, gems and jewelry, or business valuation. In each specialty, USPAP provides an ethical and methodological framework. Compliance with USPAP is mandatory for appraisers performing assignments for federally related transactions and is widely adopted as the standard for professional work in other contexts. USPAP is updated regularly, typically every 2 years, so that it reflects current best practices and regulatory expectations. Professional associations and the Appraisal Foundation. Before state licensure and federal standards, the main signal of professional competence was membership and designation in one of the national appraisal organizations. These organizations provided education, established standards, and recognized achievement through professional designations. In 1987, several of the largest valuation organizations in North America came together to create the Appraisal Foundation, a nonprofit entity responsible for setting standards and qualifications for appraisers. Founding organizations included the American Institute of Real Estate Appraisers, the Society of Real Estate Appraisers, the American Society of Appraisers, the American Society of Farm Managers and Rural Appraisers, the International Association of Assessing Officers, the International Right-of-Way Association, the National Association of Independent Fee Appraisers, and the National Society of Real Estate Appraisers. The American Institute of Real Estate Appraisers and the Society of Real Estate Appraisers later merged to form the Appraisal Institute, which remains a prominent professional organization today. The Appraisal Foundation operates through 2 main boards. The Appraisal Standards Board develops and interprets USPAP. The Appraiser Qualifications Board sets the minimum education, experience, and examination requirements for appraiser credentials. States look to these boards when setting their own licensing standards. Appraisers may also belong to professional associations that impose codes of ethics and practice standards similar to the way the Realtor organization uses its code of ethics. These associations provide continuing education, networking, and additional layers of peer accountability, working effectively with appraisers and addressing problem appraisals. As a real estate licensee, you will not be performing appraisals unless you are also licensed as an appraiser. but you will frequently interact with appraisers and rely on their work to close transactions. You can play a constructive role by preparing thoughtful information to help appraisers understand the property and the market without attempting to pressure them or dictate value. If you are concerned about the possibility of an undervalued appraisal, you can prepare several items before the appraiser visits the property. One is a carefully selected list of comparable sales. These should be as similar as possible in location, size, age, and condition, ideally within about a 1-mile radius and within a recent time frame, such as 90 days when market conditions allow. Another helpful item is a concise feature sheet, highlighting significant characteristics, such as a superior view, major permitted additions, or high-quality upgrades that may not be obvious. Routine cosmetic work, like fresh paint, is usually less relevant, but substantial improvements can matter. It is also wise to review the assessor's data for errors in square footage, room count, or other basic facts, and document any discrepancies. You can provide these materials to the appraiser ahead of time or have them ready when you meet at the property. When the appraiser arrives, it is appropriate to verify their identity, walk them through the property, and point out features you believe are important. Your role is to inform, not to advocate for a specific value. If you later believe an appraisal contains factual errors or omits key comparables, you can request a reconsideration of value through the lender, providing documented support for your concerns. Because appraisal requirements and credentialing standards can change, it is important for practitioners to monitor guidance from state regulatory agencies. For example, in 2018, the Appraiser Qualifications Board adopted changes to real property appraiser qualification criteria, and states were allowed to implement those changes on or after May 1st of that year or to retain stricter criteria. Each state decides how and when to adopt such changes. Review summary. In this section, you deepened your understanding of the income approach by looking closely at how income and expenses shape an investor's target price. You followed Tom as he built a realistic budget, allowing for vacancy, operating costs, and capital reserves, and then used his desired profit level to back into a maximum purchase price. You then saw how the same logic is used in a formal income approach for larger properties, moving from potential gross income to effective gross income, to net operating income, and then dividing by a capitalization rate derived from comparable income properties to estimate market value. You also stepped into the regulatory framework that governs appraisal practice. You learned that the Financial Institutions Reform, Recovery, and Enforcement Act created a requirement that appraisals used in federally related transactions be completed by state-certified appraisers who meet criteria established in coordination with the Appraisal Foundation. You explored the role of the uniform standards of professional appraisal practice in defining competence, scope of work, due diligence, and disclosure of extraordinary assumptions. You saw that appraisers may work in many specialties, including real property, personal property, mass appraisal, and business valuation, and that professional associations and standards boards support their education and ethics. Finally, you learned practical ways to collaborate with appraisers and respond constructively if an appraisal appears to undervalue a property. Discussion. How do vacancy and capital reserves influence the price an investor like Tom is willing to pay for a rental property? Answer. Vacancy and capital reserves both reduce the property's net cash flow. Vacancy acknowledges that the property will not always be fully occupied, and capital reserves set aside funds for major future repairs. When these items are subtracted from gross rent, the remaining profit is lower, which means an investor must lower the purchase price to achieve the same rate of return. Ignoring them would overstate profitability and lead to overpaying. Why is the income approach often preferred for valuing apartment buildings and shopping centers, while the cost approach or sales comparison approach may be more appropriate for other properties? Answer. The primary reason is that the true economic value of income properties lies in the income they generate, not just in their construction cost or the price of comparable buildings. Investors buy such properties for their income stream and required return on investment, so the income approach mirrors how buyers make decisions. For owner-occupied homes or unique special-purpose buildings, income may be less central, and sales comparison or cost may be more informative. What is the purpose of the competence provision in USPAP, and how does it protect clients and the public? Answer. The competence provision requires appraisers to honestly evaluate whether they have the necessary knowledge and experience to perform a given assignment. If they do not, they must either acquire the needed competency, associate with someone who has it, or decline the work, and disclose any lack of competency to the client when appropriate. This protects clients and the public by reducing the risk of poorly informed or unreliable appraisals in unfamiliar property types, markets, or valuation problems. How can a real estate agent help combat a bad appraisal without violating ethical or professional boundaries? Answer. An agent can gather strong, relevant comparables, prepare a feature sheet that highlights important property characteristics, correct errors in county or assessor data, and provide this information to the appraiser in a professional, non-confrontational manner. If the appraisal appears to contain factual errors or overlook key data, the agent can request a reconsideration of value through the lender. Supplying documented evidence. The focus should remain on facts and market data, not on pressuring the appraiser to reach a particular number. Closing remarks. Valuation is where the art and science of real estate intersect. On one side, you have the rigor of formulas, cash flows, and capitalization rates that help investors like Tom decide what to pay. On the other side, you have a network of regulations, standards, and professional organizations designed to ensure that appraisals are competent, ethical, and credible. As a real estate professional, you stand at the crossroads between these worlds. The more fluently you can move between investor language and regulatory language, between income statements and USPAP standards, the better you will serve your clients. The income approach gives you a powerful lens for understanding income-producing property. The regulatory framework of FIRREA, USPAP, and state licensing gives you confidence in how appraisals are prepared and reviewed. Together, they form a foundation for sound decisions, honest representation, and safer real estate markets.